A quiet but significant rotation is sweeping through the enterprise software space. While retail traders focused on index-level volatility, institutional capital spent the last week aggressively repricing two of the industry's most fundamental players. Oracle and IBM just endured one of their sharpest weekly sell-offs of the year, pushing their technical indicators into deeply oversold territory. This is not just a momentary dip. It represents a fundamental recalibration of growth expectations and infrastructure spending. To understand where the smart money is heading, we need to look beyond the immediate red screens. Let us begin by breaking down Oracle's structural footprint. Historically known as a database heavyweight, the company has spent the last decade aggressively transitioning into a cloud infrastructure provider. Through Oracle Cloud Infrastructure, they have positioned themselves as a highly competitive alternative to legacy hyperscalers. Their core moat relies on deeply embedded database management systems that enterprises simply cannot migrate away from without massive operational risk. By wrapping these core systems in their proprietary cloud architecture, they have secured a highly recurring revenue base. But that is only part of the story. Here's where the comparison becomes fascinating as we turn to IBM. Under its current leadership, Big Blue has systematically stripped away legacy hardware business lines to focus intensely on hybrid cloud services and enterprise artificial intelligence. By leveraging their acquisition of Red Hat, they have established an open-source architectural foundation that allows massive corporate networks to manage workloads across multiple cloud ecosystems. Unlike companies reliant purely on hardware sales, IBM operates as a critical systems integrator. This makes their business model exceptionally sticky, even during macro downturns when enterprises restrict direct hardware capital expenditures. To understand the immediate catalyst behind this week's technical damage, we must look directly at the quarterly metrics. Oracle's recent financial statements revealed a complex picture of expanding capital commitments meeting decelerating near-term billings. While cloud infrastructure revenue surged by double digits, overall margin expansion faced pressure from massive data center construction costs. The market reacted swiftly to this mismatch, expressing concern that near-term cash flow is being sacrificed for long-term capacity building. This created a classic pricing disconnect where short-term execution hurdles overshadowed robust multi-year bookings backlog growth. Now look at how the broader sector is reacting by examining IBM's latest balance sheet updates. The company reported steady growth in its high-margin software segment, driven primarily by strong adoption of its containerization platform. However, their consulting division experienced a noticeable cooling trend as clients deferred discretionary IT modernization projects. This shift created a slight drag on aggregate revenue metrics, despite healthy free cash flow generation. The market chose to focus on the consulting headwind, triggering an aggressive capital rotation out of the stock, despite its solid underlying structural cash profile. The next critical signal comes from management's capital allocation updates during recent briefings. Oracle's leadership team has made it clear that they are not backing down from their aggressive infrastructure footprint expansion. They are actively securing massive power agreements and cutting-edge silicon allocations to meet unprecedented multi-year enterprise demand. According to their projections, the current capacity bottlenecks are the only gating factor preventing even faster revenue acceleration. This suggests that the current capital expenditure drag is a deliberate strategic choice to capture dominant market share, rather than a sign of structural weakness. On the other side of the landscape, IBM's executive strategy is centered on scaling their generative artificial intelligence consulting pipeline. Management noted that their specialized enterprise AI platform has seen rapid interest, with the transactional book of business doubling over the past year. They are deliberately steering capital toward high-value software integrations while restructuring lower-margin consulting contracts. This execution vector is aimed at systematically raising operating margins over the next fiscal year, presenting a contrasting strategic path to Oracle's capital-intensive physical infrastructure build. That leads us to a larger question regarding the macro environment. Enterprise software providers do not operate in a vacuum. Currently, the entire corporate landscape is grappling with sustained interest rate pressures and tightening IT budgets. Chief information officers are under immense pressure to show immediate returns on technology investments, moving away from experimental cloud projects toward proven productivity tools. This shift in buyer behavior has created a highly selective spending environment, where platforms that offer clear efficiency gains are winning, while speculative long-term initiatives are being postponed. In this tight spending environment, competitive dynamics are intensifying significantly. Hyperscale giants like Amazon Web Services and Microsoft Azure are engaging in targeted pricing structures to secure dominant workloads. To compete effectively, both Oracle and IBM have been forced to form unexpected strategic partnerships, integrating their proprietary tools directly into rival cloud environments. This co-opetition model is redrawing industry boundaries, making multi-cloud support a mandatory standard. The companies that can integrate seamlessly without sacrificing their pricing power will emerge as the primary beneficiaries of this structural transition. However, the path forward is not without severe risks that institutional investors must weigh carefully. For Oracle, the primary vulnerability lies in their elevated debt load, which was significantly expanded during their multi-billion-dollar acquisition of Cerner. If the integration of this massive healthcare platform continues to experience delays, it could restrict their ability to fund critical capital expenditures for cloud infrastructure. Furthermore, any sudden slowdown in global enterprise cloud spending would immediately pressure their high valuation multiple, leaving very little room for execution error. For IBM, the core operational risk is centered around their exposure to traditional IT consulting cycles. If corporate clients continue to defer large-scale digital transformations, the software division may not be able to fully offset the revenue drag from the consulting slowdown. Additionally, competition in the artificial intelligence enterprise integration space is exceptionally fierce, with nimbler consulting firms and specialized cloud natives aggressively undercutting pricing. Management must execute flawlessly to prevent their high-margin software segments from being cannibalized by legacy service declines. Let us look at the valuation reassessment that this sharp sell-off has triggered. Prior to this rough week on Wall Street, both of these legacy names had run up to historic premium multiples. This correction has successfully flushed out weak momentum capital, bringing their trailing and forward enterprise multiples back down to much more historically reasonable levels. Institutional analysts view this current technical pullback as a healthy compression of overextended sentiment, which sets a much more secure baseline for patient capital looking to establish long-term structural positions. Looking forward, the structural investment thesis for both enterprises remains deeply rooted in their unique operational niches. Oracle's ability to lock in massive sovereign cloud contracts and specialized enterprise databases provides a unique, highly defensive revenue stream that is extremely difficult to disrupt. For IBM, their strategic focus on hybrid cloud architectures and mainframe modernization ensures that they remain the quiet backbone of the global financial and public sectors. The multi-year visibility for both of these platforms remains robust, provided they successfully navigate the current capital-intensive phase. When we look at this through a tactical framework, we are placing both assets on our watch lists with distinct risk parameters. Oracle is entering a high-priority breakout watch zone as it approaches major technical support, where institutional buying volume has historically stepped in to defend the valuation. Conversely, IBM sits in a transitional phase where we are closely monitoring the consulting slowdown, making it a critical asset to observe for signs of stabilization before allocating substantial new capital. Managing risk here requires watching these key technical support structures closely over the coming sessions. Navigating high-volatility structural corrections requires a disciplined focus on business fundamentals rather than daily market noise. If you want to keep your portfolio ahead of these complex institutional rotations and macro shifts, subscribe to SR Money News. We will continue to deliver deep-dive, institutional-grade equity research designed for the sophisticated investor. Drop your thoughts in the comments below on whether you believe this software correction presents a structural opportunity or a signal of broader macro challenges. Thank you for watching.